Hello and welcome to your ultimate guide for the California Life and Health Examination. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your exam with total confidence. In this video we'll cover risk management, perils, hazards, insurable risk, legal principles, underwriting selection. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. And remember, our website offers free exam guides and practice questions to help you ace your exam. You'll find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started.
Let's start with the most basic question of all. What is insurance? In California, you don't have to guess because the insurance code defines it. Insurance is a contract whereby one party agrees to indemnify another against loss, damage, or liability arising from a contingent or unknown event. That single sentence holds 4 testable ideas, so let's break each one down. First, insurance is a contract, a legally enforceable agreement, not a favor or a gift. Second, to indemnify means to make someone whole, putting them back in the financial position they held before a loss. Third, it protects against loss, damage, or liability. And fourth, the triggering event must be contingent or unknown, meaning it may or may not happen. Stripped to its essence, insurance is the transfer of the risk of financial loss from a person to an insurer. You pay a small, certain premium, and the company agrees to pay a large, uncertain loss if a covered event happens. Learn the players too. The insurer accepts the risk, the insured is covered, and the policy owner holds the contract's rights. 2 more players round out the cast. The applicant is the person applying for coverage, who usually becomes the policy owner. The beneficiary is whoever receives the policy proceeds, which matters most in life and accidental death coverage. Often the insured and the policy owner are the same person, but not always, and the exam likes to test that difference. So how does this appear on your exam? You'll often see 4 sentences and a question asking which one is the California definition of insurance. Look for the words contract, indemnify, and contingent or unknown event. The wrong answers usually drop one of those, calling insurance a guarantee or a savings plan. Just remember, a contract that transfers risk. What we just covered is exactly the type of material you'll find in our free practice question bank. These aren't just basic recall questions either. They're designed to test your deep understanding and your ability to spot the right definition, just like the real California exam will challenge you to do. Now let's talk about risk, because risk is the heart of everything insurance does. In one word, risk is uncertainty. More precisely, it's uncertainty about whether a loss will occur. This matters because of a simple rule. If a loss is absolutely certain to happen, there's no uncertainty, and so by itself, it isn't insurable. Now you might be thinking, isn't it certain for everyone? How can life insurance exist? Here's the answer. While the event of death is certain, the timing is completely uncertain. We don't know when. That uncertainty of when is what creates an insurable risk. For health and sickness coverage, it's even clearer, because we don't know if or when illness strikes. This brings us to a distinction the exam loves. Pure risk versus speculative risk. Pure risk involves only 2 possibilities, loss or no loss. There's no chance to profit. Speculative risk adds a 3rd possibility, a gain. And here's the rule that earns you points. Only pure risk is insurable. Speculative risk is never insurable. Let me make this concrete. A car accident, a house fire, an illness, these are pure risks, because you can only lose or stay even. Gambling, stock market investing, or starting a business are speculative because you might actually gain. So if a scenario says someone could either lose or make money, that's speculative. and it cannot be insured. Here's a memory hook to lock it in. Pure starts with P, and so does protectable, meaning insurable. Speculative starts with S, and so does speculation, like gambling, which is not insurable. Pair P with protectable and S with speculation, and you'll never mix them up under exam pressure. That trick alone can save you a question. I know we're covering lots of detailed terms, and you might wonder how to practice telling them apart. That's precisely why I put together those free practice questions I mentioned. They let you drill these definitions and distinctions over and over until they feel automatic. Working through real questions is how these concepts truly stick. Next up are two words students constantly confuse: peril and hazard. Let's separate them cleanly. A peril is simply the cause of a loss. Ask yourself, what actually caused the damage? In life insurance, the peril is death. In health and accident coverage, the perils are injury and sickness. For property, perils include fire, theft, and windstorm. A hazard is different. A hazard is anything that increases the chance or severity of a loss. Here's the key, and the exam tests it constantly. Hazards do not cause losses. They make a loss more likely or more severe. The peril causes the loss. The hazard tips the odds toward that loss happening. Keep those two roles separate. Let me give you one more pairing to lock this in. Picture an icy staircase. The ice is the hazard because it increases the chance someone falls. The actual cause of the injury is the peril. Always ask what caused the harm, that's your peril, and what made it more likely, that's your hazard. Now, insurance recognizes three kinds of hazard, and telling them apart is one of the most commonly missed exam points. The first is the physical hazard, a physically identifiable condition you can see or measure that raises the chance of loss. Think of a diagnosed heart condition, obesity, or flammable chemicals stored in a garage. If it's tangible, it's physical. The other two sound almost identical, moral and morale, so learn them cold. A moral hazard comes from a person's character, specifically dishonesty. It's deliberate, like lying on an application, faking a loss, or committing arson to collect. A moral hazard is a careless or indifferent attitude because insurance is there, that who cares, I'm covered mindset, not fraud. Here's how to keep them straight. Physical, you can see it. Moral connects to morals and dishonesty, always deliberate. Morale connects to attitude and carelessness. A classic item describes someone who leaves her car unlocked while shopping because she figures it's insured anyway. That careless attitude is a morale hazard, not moral, because she isn't trying to commit fraud. If these similar terms feel tricky right now, don't worry at all. That's completely normal, and it's exactly why I created that comprehensive practice question bank, working through scenario questions that ask you to label moral, morale, or physical hazards will train your eye fast, so the distinction becomes second nature before exam day. Now, this is where it gets interesting. How can an insurer promise to cover millions of people without going broke? The answer is the law of large numbers. It states that the larger the group of similar exposure units, the more accurately future losses can be predicted. This is the mathematical principle that makes insurance possible. Here's how it works. An insurer can't predict whether you specifically will file a claim next year, but pull together millions of similar insureds, and it can predict with remarkable accuracy how many losses the whole group will have. Two conditions help: a large number of units for more data, and homogeneous units, meaning the insureds are reasonably similar. Think of it like flipping a coin. Flip it 5 times and you might get 4 heads, nowhere near even, but flip it 10,000 times and you'll land remarkably close to half and half. Insurers work the same way. One person is unpredictable, but a huge group of similar people becomes startlingly predictable. That predictability lets the insurer set a fair premium, which leads us to loss exposure. A loss exposure is any condition or situation that presents the possibility of a loss, whether or not a loss actually happens. A homeowner has a loss exposure to fire every single day, even in years when no fire occurs. The potential alone creates the exposure. There are 3 classic categories. Personal loss exposures threaten a person's life, health, or earning power, like sickness, injury, and disability, and these matter most to a health agent. Property exposures involve owned property, and liability exposures involve being sued. From the insurer's side, exposure is measured in units, and for life insurance, 1 unit is $1,000 of death benefit. Here's how that's used. Premium equals the rate multiplied by the number of exposure units. So if the rate is $32 per thousand of death benefit, a $100,000 policy has 100 units, and 32 times 100 gives a premium of $3,200. And remember, a loss is a reduction in an asset's value. Remember that mastering these concepts takes practice and application. The free practice questions are designed specifically to help you take what you're learning here and turn it into exam-ready skills. They include the same premium and exposure reasoning we just walked through, so you can build real confidence before test day. So once we know a risk exists, how do we handle it? There are 5 recognized techniques for managing risk, and they fit a handy acronym STAR. That stands for sharing, transferring, avoiding, reducing, and retaining. Each is a different strategy for dealing with the possibility of loss, and the exam will ask which technique a scenario shows. Let's walk through them. Sharing means 2 or more parties each pay a portion of any loss, like members of a risk pool. Transferring means shifting the risk to another party, and insurance is the prime example, since your risk passes to the insurer for a premium. Avoiding means eliminating the risk entirely by not doing the activity, like never skydiving. That leaves reducing and retaining. Reducing means lessening the chance or severity of a loss, like wearing seatbelts or installing smoke alarms. Retaining means keeping the risk and paying for any loss yourself, like choosing a high deductible. On the exam, a security system is reduction, buying coverage is transfer, and paying it yourself is retention. Here's something elegant about how insurance fits these techniques. Insurance is the classic transfer technique, but the insurer then uses sharing, pooling everyone's premiums plus the law of large numbers to spread a few large losses across many insureds. That combination is the only reason premiums stay affordable for everyone in the pool. Closely tied to this is spotting a risk situation, any circumstance where a loss could occur. This is the core skill of an agent. You identify a client's loss exposures, then recommend coverage. For a health agent, the big ones are getting sick or injured, becoming disabled and losing a paycheck, and needing extended long-term care later in life. Picture yourself sitting with a young client who earns a good salary but has no savings. You'd spot several loss exposures right away. If she gets sick, there are medical bills. If she's hurt and can't work, her paycheck stops. Each exposure points to a product, medical coverage, and disability income that you can recommend. But here's the thing, not every risk can actually be insured. To be ideally insurable, a risk must meet 6 requirements, and Kaplan organizes them with the acronym CAN-HAM. That stands for calculable, affordable, non-catastrophic, homogeneous, accidental, and measurable. Let me unpack each one, because the exam will ask which requirement a risk fails or satisfies. Calculable means the chance of loss can be figured from past statistics. Affordable means the premium is feasible for the average buyer. Non-catastrophic means the loss can't wipe out the insurer by striking everyone at once. Homogeneous means a large number of similar units, so the law of large numbers works. Accidental means due to chance, not intentional. Measurable means definite in time, place, and amount. Here's the part most students miss. Why is war typically excluded from policies? Because it would violate the non-catastrophic requirement, producing far too many losses at the same time, and which requirement ties directly to the law of large numbers. The homogeneous one, the need for a large number of similar exposure units. Those are favorite exam questions. As we move into the legal side of insurance, remember that understanding these concepts is just the first step. The real mastery comes from applying them, which is where those free practice questions become invaluable. They cover every objective on this exam, and they're designed for California license success. Grab them from the description before you forget. Now let's talk about what the law lets you insure against. California Insurance Code, Section 250, defines the insurable event. It says any contingent or unknown event, whether past or future, which may damnify a person having an insurable interest or create a liability against him, may be insured against. Notice that same uncertainty requirement, contingent or unknown. Here's something that surprises a lot of people. An event can be insured even if it has already happened, as long as it's still unknown to both parties. The classic illustration is a cargo ship that has already sunk at sea, unknown to anyone, and can still be insured for that voyage. What matters is the uncertainty, not whether the event is future. That definition mentioned insurable interest, a principle you must be able to apply. Insurable interest exists when you would suffer a genuine loss, financial or emotional, if the insured event occurred. You can't insure something you have no real stake in, because that would turn insurance into gambling. A man who buys a policy on a total stranger has no insurable interest. California recognized insurable interest based on a reasonable expectation of financial advantage or a substantial interest born of love and affection. So you have unlimited insurable interest in your own life, and it's presumed for close family. Here's the critical timing rule. For life and disability insurance, insurable interest only needs to exist when the policy takes effect, not at the loss. The second great principle is indemnity. Indemnity means a policy restores you to the financial condition you were in just before the loss. No better and no worse. It applies to medical expense insurance, which reimburses your actual covered costs, so you can't profit from being sick. It doesn't apply to life insurance because you can't restore a life, so life pays a fixed amount. The third principle is utmost good faith. An insurance contract assumes complete honesty and full disclosure of material facts from both sides. Each party may expect the other won't conceal important information or act deceptively. So if an applicant hides a known heart condition, that breaks utmost good faith through concealment, and the insurer may void the contract or deny the claim. Let's apply all three quickly because the exam will. A man insures a total stranger hoping to cash in. No insurable interest, so it's not valid. A health policy pays your actual hospital bill but nothing extra. That's indemnity. An applicant hides a heart condition. That's a breach of utmost good faith, and the insurer may rescind. Now let's see how an insurer decides who to cover. That job is underwriting, the process of evaluating and classifying a risk to decide whether to accept it and at what premium. Its purpose is to protect the insurer and the pool from bad risks, and to price each applicant fairly for the risks they bring. Here's a fact the exam loves. As the agent, you are the insurer's first line of risk evaluation, often called the field underwriter. Before an application reaches the Home Office, you gather accurate, truthful information. Complete the application fully, screen out obviously uninsurable risks and submit it. And watch out, because an incomplete application gets returned and delays everything. Let's put the steps in order, because that flow can be tested. First, you complete a truthful, complete application as the field underwriter. Next, the Home Office reviews it against company guidelines. Then they gather any extra information needed, classify the risk, and finally make a decision. Accept as applied, accept with a rating, or decline. Once the application reaches the Home Office, underwriters may gather more information. They might pull an MIB report, coded medical history shared among member insurers. They might request an attending physician statement, order medical exams and lab tests paid by the insurer, or check motor vehicle records. The riskier the case, the more they investigate. After reviewing everything, the underwriter sorts the applicant into one of 4 classes, and you must know all 4. Preferred means a better than average risk with the lowest rates. Standard means an average risk at standard rates. Substandard, also called rated, means a higher risk that pays more or gets a rider. And declined means the risk is uninsurable. California adds important fairness rules here. Underwriting factors must be objective and tied to the real cost of loss. Insurers may not unfairly discriminate based on a person's HIV or AIDS status, and they may not use genetic characteristics or sexual orientation against an applicant. The exam may test that these factors are off limits in classification. All of this underwriting exists to fight one big enemy: adverse selection. Adverse selection is the tendency for higher than average risks to seek out and hold on to insurance more aggressively than healthy people do. Why is that dangerous? Because rates are built on average loss experience. If mostly the worst risks buy and renew, the insurer pays far more than it collected. Underwriting is the cure. When an underwriter spots a higher than average risk, the insurer can charge a rated premium, limit the coverage offered, or decline the application. The goal is a profitable distribution of exposures, a balanced spread of risks across preferred, standard, and substandard classes, so actual losses track the predicted average. Sound underwriting restores that balance. Don't forget to grab those free practice questions from the link in the description. With the depth of knowledge you've gained today, plus repeated practice from those questions, you'll walk into your California license exam genuinely prepared and confident. They're completely free, so there's no reason not to use them as your final review. Let's bring it all together. You now know that insurance is a contract that transfers the risk of loss to an insurer, and that risk itself means uncertainty. You can separate pure risk, which is insurable, from speculative risk, which is not. You can tell a peril, the cause of a loss, from a hazard, which only increases the chance of one. You understand the 3 hazards: physical, moral, and morale, and how the law of large numbers lets insurers predict losses and price them fairly. You can name the 5 risk management techniques in STAR and the 6 requisites of an insurable risk in CANHAM. And you've seen the legal backbone, insurable interest, indemnity, and utmost good faith that holds every policy together. Don't underestimate how much ground you've covered. You can quote 2 California statutes, Section 22 for insurance and Section 250 for insurable events. You can apply insurable interest, indemnity, and utmost good faith to real scenarios, and you understand underwriting from the field all the way to the final decision. That's genuinely exam-ready knowledge. Finally, you can walk through underwriting, recognizing yourself as the field underwriter, naming the 4 risk classes, and explaining how good underwriting defeats adverse selection to build a profitable distribution of exposures. Notice how it all connects. Uncertainty creates risk. The law of large numbers tames it, and underwriting keeps the whole pool balanced and healthy. You've built a strong foundation today, and these 7 questions on your exam are now well within your reach. The terms that once looked confusing should feel clear and familiar. Your next step is simple. Go practice. Open those free questions in the description. Drill these definitions until they're automatic, and you'll walk into that exam room ready to succeed.